Okay, it is Wednesday, November 3rd. It's 4:30 p.m. Eastern Time in the US. This is a post-Fed analysis of the four primary US trading indices, and the lens through which we're going to look at the markets is, as usual, an auction market lens. We're going to use bar charts. We're going to use market profile charts. We're going to take a look at market internals, but the overarching methodology is auction market principles, how markets develop. And we'll get into that a little bit because it's very important and it's actually tradable, usable information. So let's see. Let's start with this. Okay, you guys see my screen? I have talked for dozens of minutes before without my screen or without sound, so I'm hyper vigilant now. Also recording, that's good. So everything seems to be on go. Yeah, thank you, Lee. Yes. Okay, you can see on my screen, these are the cash indices. We'll look at some of the cash. We may use some futures charts for some stuff, but the cash market is really the dog. The futures is the tail. And you can see we had a wide range up day. Now, those of you who have heard me say anything about the market in the past few months had to have heard me pound the table about the Russell and the importance of the Russell on an intermediate to long-term basis. And yesterday, and something happened that has not happened in, well, many, many months. We closed at an all-time high in the Russell, and that's following balance of like 8 or 9 months, one of the longest balance areas of the stock indices that I can recall. Now today, this was a resounding confirmation of this breakout to the upside that occurred marginally yesterday. And what this signals, and this is important, and I'll tell you what will invalidate this signal, but what this signal is that it is very, very likely now that the bull market in equities in the US has many, many months to run, many months. All four of the primary US trading indices closed a new all-time high ground today. It would be, I think, unprecedented for this to be a top of any top that occurs in the next few days to a week or so, and there will be one, being of anything more than of rotational significance. And I'm going to talk about, I will define that later in this video, but it's just today was an event with all four of the indices closing a new high, all-time high ground that is very, very significant in terms of the life of this bull market. Until this occurred, and especially when we had the Russell trading near this high volume node that it kept rotating around, trading at it, trading below it, that sort of left open the door. Okay, maybe we're forming a major top in the other indices, and the Russell is the canary in the coal mine. Well, that's been shot down. And now the Russell has joined the party, and to one degree or another, it should trade higher without retracing at a worst case, absolute worst case. If the Russell were to close below the low here on the first, what was that, Monday, then we would revisit things. But I don't think you're going to see that. As a matter of fact, I'd be a little bit surprised now if you see the Russell close below today's low prior to more upside. And as a matter of fact, I would be surprised if we see a close below today's low in any of the indices at this juncture prior to more upside. A general guideline when a market is trending, when a market is in initiative development and market profile parlance, okay? What that means is it's trading, it's trending. One side or the other is in control of the market and is pushing it higher. It's an imbalanced market, and that's what we have. Buyers are in total control. It's imbalanced to the upside. The buyers are overrunning the sellers. That's market profile, auction market 101. Now, when you're in a strong trend, a general guideline, and you can go back and you can confirm this on any asset that you choose. It can be corn, it can be Amazon, it can be gold, silver, bonds, whatever you want to choose. When you're in a strong trend, a general guideline is that the previous day's extreme or the day before that's extreme, so the 2-day extreme, should not be closed below. So what that means from a practical perspective is that Monday's lows, which is here, roughly here in the SPX, here in the Index, and you can see the Russell is yesterday's low and today's low is pretty close. And then in the Dow, it's right here. So these are the immediate, if we were to turn around tomorrow and all 4 of these indices close below that level, I would be surprised. And that would be something to visit, okay? Now, if they're tested and we form balance, that's another story. But the action today confirms a bullish scenario, and it's even, the major event is the fact that the Russell is confirming the bull market, really. Now, let's take a look. I have some notes here. Let's just take a look at where we are in terms of this last leg higher. And I'm going to get rid of this. If you have questions, you can type them in the chat and I'll try and keep up with it. Let me put that over here so I'll see it. Okay, so we have been vertical since in the ES, the 13th. Now, and I think it might be one or the other, might have been the 12th, but in the ES it's the 13th. So from the low of the 13th to today's print high, we're up 7.73%. And I'm going to talk about what this is, because what this is from an auction market perspective is very important. And it also helps us forecast what's next. But for now, I just want you to take it at face value. This swing higher, and it has been relentless from here to here, is, roughly 7.7%. And within that, we've had one minor blip to the downside. I mean, it's been, this market, the indices have been characterized by an historic bid since the March 2020 low. This is it. It's just continuing. So let's take a look at previous ramps similar to what we have now, because, and I don't use, and I hate the term overbought, because there really is no such thing. It's such a nonsensical term. The market determines what's overbought. You can't confirm that except in hindsight. So I don't use it. But again, you can forecast what's going to come next. And I'll get into that in just a minute. That'll be part of this. So we're up almost, 7.73%. Here are previous ramps. Now, by the way, let me tell you what these green arrows represent, and we'll get into that also in a little bit. And these are very important levels, markers. And what these markers are, it's when breadth closed at -2,000 or greater. I'll talk about that later, but just so you know what the arrows are, these are the dates on which Brett closed at negative 2,000 or greater. So we're up 7.73%. How high does this go? Well, you don't know. Nobody knows. That there are going to be all sorts of guesses and fib counts and Elliott wave extensions and Gann angles and demarc counts, and I can go on and on and on in the various forms of magic that are going to be used to project where this stops. There'll be so many of them that somebody will be right. I'm not going to make that guess. That's out of my depth. But I can tell you what's going to happen next. Not exactly where, but I can tell you what's going to happen next. But let's look at these previous ramps higher. So this, and I'm going to take the vertical ramps. I'm not going to necessarily take to the exact top before a 1 or 2% decline. I'm just going to take it from the point that it began to the point that it became two-sided. So this was 4%, this was 4.2, this was about 5.5%. All right, here's one that is similar in magnitude to what we're seeing. This was off the March 25th low, about 8%. This was about 7%. This was about 7%. Okay, now this one was interesting. This was the strongest. This was about 12.7%. So considerably greater than what we're seeing here. This was 10.7%. This was 17%. This was 16.7%. Now I discount. I think we're in a different market condition really than what we were in this phase. This is the historic, most compressed low of my lifetime. Notice I didn't say oversold because I hate that term. But the market was extraordinarily compressed here. And I was looking for a low here. And you can go back in reports and stuff that I was posting, and you hear that. Of course, now I was looking for a low over here too, in the interest of intellectual honesty. So I was early, but we got a historic low here, and it's not unusual to see these just silly moves off of lows of this magnitude. And you can see the rallies following the minor retracements have begun to come in somewhat. I mean, we did have almost an 11. This was almost 13%. And then, we sort of got in a pattern between 7 and 8.5%. And then it really slowed down until this one. Well, this one is 7.73%. Now, is it going to go to 16%? Sure, it could. Or could this be, today could be the top of the momentum peak in this rally? Could be. But you don't know. But here is what is going to happen next, okay? This is Tom's big prediction. This is as far as I go with magic. And this is based on how markets develop. An auction market has a 3-step process of development. You have a trend, you have a stopping price, you have a development around that trend, then it breaks and it either continues or it reverses in another direction. So this is the classic step 1, okay? This is step 1. Now, I don't know if step 1 is complete, but step 1, even if it's not complete, is not going to go higher at the rate of change that we've been going up since this low. I think we're, this is, I don't know, 16 or 17 trading days. There's all sorts of factoids about this particular rally. I will send you over to Twitter to get the minutia in that. It really doesn't matter. But what is going to happen next is the market is going to become more two-sided than it is now. What does that mean? Well, it means that on a day-to-day basis, you're going to see, maybe, and I don't know where it starts, but you are eventually going to see this. Or maybe it goes a little bit higher and you see this, but you're not just going to continue to see this thing go up indefinitely. And the higher it goes without this, the more likely it is that it corrects extremely sharply in one of these something like this, where you just get so silly and extended to the upside that your initial move off is just, it's an air pocket that takes your breath away. So that's in play, but I don't think that's what's going to happen. What I think is going to happen is something more like this. So let's say that, we're going to go a lot higher into the end of the year. It's seasonally positive, all of that stuff. And it may, I don't know, but it's not going to go up at this rate of change. So what could happen, I think worst case, if it goes straight up, or the most bullish case, if it goes straight up from here or continues higher from here, is similar to what happened off this November low back in 2020, where we went higher into late February before we got any sort of significant retracement. But you can see what happened in here is that the market became very two-sided, where you had not just intraday rotation, but you had day-to-day rotation, where you would have these minor balance areas and these air pocket spikes lower. Here's one. The market traded higher this entire time, but you had deep overlap on a day-to-day basis, where the previous day lows were tested, and then you rallied, and the second day back lows were tested, and then you got a little bit of a dip in here, and then it went higher. But it became very two-sided from this point all the way up into really the end of February. So this can continue for months. We could go higher for months here, guys, but we're not going to go higher as vertically as we have been moving higher. That I am about as confident as I dare get in analyzing a market. Now, the other part of this that I want you to notice, and this is, I'm not a cycles guy, but it's pretty clear what has been happening really since May is about every 2 months, you get some sort of cleansing of the internals, and you get some sort of retracement, and that creates a negative 2000 breadth reading. So this would be quote unquote be due in that pattern somewhere around the 15th to 19th of November. So we'll see if it holds up. That's not tradable information. It's just information. But I will tell you that if we go past that date, the market is on a clock, and you will see this negative 2000 sooner rather than later. Now, I want to show you this, and I want to show you from a market profile perspective. And most of you have are clients or have been clients or have listened to my work before. And I always emphasize, I am not a market profile trader. I have used market profile for 35 years, but I'm not a market profile trader. I think it's dangerous to label yourself as a type of trader. I am a trader first and foremost. The form of analysis that I use are auction market principles, and the tools that I use to help me with that analysis, is designed to help identify market condition. Because if you know market condition, then you have a real good idea about the strategy and the tactics that have the highest expectancy based on that market condition. So that, I'm using auction market principles, and the tools I use are bar charts and the market profile chart. The market profile chart is nothing more, nothing less than a graphing format. Now, it's an ingeniously designed graph that emphasizes trade activity on the horizontal scale, so you can see relative value as determined by buyers and sellers and how much and where they're doing their business. Okay, let's take a look at the profile view here that I have somewhere. I actually organized my charts before this, so I wouldn't go through this tedious process of trying to find my charts, which obviously was a fail. So let me find it. Here we go. Okay, so this is, I'm going to just do the cash chart. This is the S&P. I'm just going to do the S&P. Exact same concepts. The process that I'm going to go through here is the same process you use for any of the indices. Now, all the indices are in the same form of development now, which makes this relevant regardless of the index that you trade. So part of the problem with market profile and market profile traders is that market profile, because it's a computer program, is binary, and you have to have limits, some limits. How do you profile the market? Well, we use chronological limits of various 30-minute time slots, daily, monthly, etc. What you're viewing here is a market profile of months. Each month is an auction. Actually, each month, that's not accurate. Each month is a profile unit. It's a mistake to assume that each month is an auction unit, because the auction is an ongoing process of development. And you can't just look at a glob of letters and infer necessarily what, the complete picture of what's going on. And that's certainly the case now. Now, I talked about this, I think it was in last weekend's report. So what I'm going to do, I'm going to split out. This is the beginning of November. Now I'm going to split out the beginning of October. I'm going to split out October. Now what you can see, forget dates, forget the chronological constraint that most people want to put on market profile, and what you want to identify as market condition through this auction market lens. So what is this market doing? Well, it's pretty clear. It's clear the phase of development that we are in now is we're in vertical development. This is a step one for those of you that are familiar with that concept. And what follows is going to be a step two. This is a distribution. A distribution is a range. Now, this particular distribution is not a very mature range because it doesn't have this in it. It doesn't have this in it. Doesn't have this in it. It has not identified an area of value. It is in search of value. That's what imbalance is. It's a market that's in search of balance. It's in search of an area where trade can be better facilitated than it has been since this March 12th low, which has been completely dominated by buyers. But at some point, the buyers will, the last buyer will come in and the market will begin to rotate. And where that begins, as I said before, is at best an educated guess, but it is a certainty that what we will see sooner rather than later is this. You're going to have this form, this form, this form, this form, etc. It is as sure as night and day. There's no exception to it, and there's really no exception to it in any time frame. We're analyzing this on month-to-month basis. Now, I want to go back and show you a couple of other situations that are, I think, analogous to this. When I have my notes here, let's go to June and July. Okay, so this was back in June. I'm going to split this out. Now look, this is, you have this nice Gaussian shape here, and then you have another auction here. But if you're looking at this, it's not tradable information. You have to understand the market is going to form the structure. The market will become two-sided. Price is regressive, yes, but it's regressive around value, and value migrates. So presently we're in a market, the market that we're trading is in search of value. And so far value seems to be higher according to the participants. So if we go back in June and we split this out. So at the end of June, or it's probably third week in June, we started vertical development and it carried over into July. And this is sort of, again, it's sort of analogous to the situation we're in now, where you had a furious rate of change into this high, and then the market got two-sided. Then you had another thrust higher, and you had more balance in here. Then you had a bigger downdraft. But the point is, this was the stopping price. This was the step two. And again, it's on step two is on. You can only be identified in hindsight. You can't. You're guessing if you say, okay, well, 45.73.2 is going to be the stopping price. Okay, well, that's out of my depth again. But the market is going to become two-sided. And then if you look at this, same thing happened again. And this was in July. So you had this dip down here, and you had this furious rally. And then what happened? Well, what happened is what always happens. The market became two-sided. Then you had another initiative move. And this goes on and on and on. I could go back to 30 years and show you the same process. It happens all the time. And just when people think, oh my God, it's never going to have a down day, it does, and it will. Okay, let's see. That's June, July, August. Let's go over here to March. Okay, so here in the last week of March, and this was, I don't want to get too far off the rails here, but this actually was a false breakout trade also, but that's another conversation. All right, so we had this furious ramp. That began the third week in March, right? Straight up. And then what happens? Well, what happens is what always happens. We have balance. Now, the balance wasn't very deep, but it occurred. And, this was, in hindsight, this was your stopping price right here. And the more vertical the market is, the more likely it is that the horizontal development carries over into the next time frame, which it did here. It became very choppy and two-sided in May. So let's see if this is the last one. Oh, here we go. All right, let's go to the November example. Now, this was, I mean, silly. We had so many gaps here, and we weren't up that many days out of the off this low. I don't think it was nearly as time-wise. It was farther, but the number of days was very short. And then what did the market do? Well, the market began to rotate. Now I want to show you, and this is that period of time. This was a similar period of time that we're in now. It was that seasonally positive time of year. And what did the market do? Well, it continued to trade higher and higher and higher. You can see the migration of value as denoted by the pink lines here, the magenta lines here. You can see that was higher, but you can also see how much overlap and how day-to-day choppy the market became following this ramp up into this early November high. So right now, you know, we could go a lot higher. We're going to go higher into 2022, maybe, but we're not going to go at this rate of change. And if we do go higher, it's much more likely to be more two-sided, both intraday as well as day-to-day than what we're seeing now, okay? All right. So that is the profile view. That's the auction market view, this three-step process that is incredibly persistent and consistent because it's how the market was designed. It's how an auction market is supposed to work. An auction market is designed for trade facilitation. And that's what makes these patterns in this three-step process so, dare I say it, predictable. It's predictable within reasonableness. It's not trying to predict a market top to within, 200 basis points or 20 basis points, I should say. So the next thing that's going to happen is we're going to have a slowing of this trend off of this, and we're going to have a more rotational market. Now, let's look at something else that I have found very, very useful. And it's breadth. It's NYSE data. And let's see here. Here we go. And here it is. Now here are here are the levels, the negative 2000 breadth readings. And if and when that happens again, you'll be well served to pay attention to it, because in every single instance since the March 2020 low, that has been a momentum low, if not the price low. This was the momentum low here. We went a little bit lower here, but ultimate result was approaching an 8% rally off of this level. Probably already is an 8% rally off of this level. So you can go back and you can do this yourselves, and you can see these levels. Now, the other thing I want to emphasize that I have said 7 million times, but I still get asked questions about it. Well, what about the divergences at between price and breadth in determining we're going to have a high? It's not helpful. It can get you in a lot of trouble. There will be at the top, wherever that is, there will be a divergence between price and breadth. The problem with that is it's not tradable because you get so many false signals. There'll probably be a dozen divergences that will yield little to nothing before something of significance occurs. I've got a question here. Tom, you said the highest use for market profiles to determine market condition. Does that simply mean to identify whether the market is in vertical versus horizontal development? No. It also means, and there's some art in this, Stephen, to be very candid. You sort of get a feel for when a vertical development is getting extended, when vertical development is more likely than not to begin transitioning into horizontal development. And I think, quote unquote, we're at that stage now. Now you can see on my chart here that, we might go up another, 40% from here, and we ultimately don't become particularly two-sided until we're up 17%. But the probabilities are right now that we're closer to some horizontal development, two-sided trade than not. Now, regarding horizontal development, and let's take the Russell, for example. That was one of the longest periods of horizontal development in the stock index futures that I can recall. You can look at the ES or the NQ or the Dow, and typically in this market, if you go 4 or 5 days in horizontal development, i.e. balance, that's a long time. Well, the Russell just went like 8 months. But when you recognize what's going on, you can prepare for it, and you can effectively apply trade strategies and tactics that will allow you to catch the move, or at a minimum, not get hurt. Okay, to answer. So that's a good question. But no, it's not simply to identify whether the market is in vertical or horizontal development. The more nuanced part of it is knowing that the market is always in this transitional process from horizontal development to vertical development, and then catching that transition, and then trading when it becomes clear, for instance, that we're in balance, then trading that balance as opposed to trading it in an initiative manner. Okay. So, yeah, I want to go back and emphasize the importance of not leaning heavily on this information to think that, you know, we're on the cusp of a 10% market decline. You know, when that 10% market decline is over, we're going to be able to go back and say, look, see that divergence? It was right there. But, you know, you're going to lose 20% if you trade every single signal between now and that 10% decline occurring. So I've worked with this, I use it, but it's very important to point out the flaws of the things you use, as well as its benefits. Breadth is much more effective at identifying lows in all time frames than it is in identifying highs. Okay, so at the moment, you know, we're reaching an upper extreme in the 5-day moving average of advancing issues. Now, does that mean we're going to have a top? No, go back and revisit what I just said. But I'm making note of it, okay? And I'm going to show you something in a minute that can be more helpful on a 2-3 day basis and intraday using breadth than this. This is sort of a blunt instrument, particularly when you are trying to divine highs. You can't, and something that I always say, you always default to price action. And that's really something that's very simple. You know, the market is going higher until it isn't. And it isn't, you know, it isn't when it takes out some important level. That can be the 2-day low back. It can be the previous day's low. It can be an intraday multi-hour pivot. But until you have a signal in some time frame that the market is turned, you don't just sell it just because it's going higher. You have to have some trigger. And that's where your strategy and your tactics come into play. That's beyond the scope of this webinar. So let's see here. One last thing, and this may be for those of you that are in the room, you've seen this. Now, this is a chart that I lean very, very, very heavily on, that I do find extremely useful. And what I will tell you about breadth is that you never fade the slope of breadth. So if breadth is sloping higher, even if breadth is negative, you don't fade the market, you don't sell it. And now there are times, and this speaks to the disconnect between using breadth at lows and using it at highs. There are times where the market will go higher and on negative breadth. Now, typically breadth will be sloping up, but it'll be negative. But you can't just fade the market if breadth just because breadth is negative. It is the slope of breadth that's most important. But what you will see, I'm going to scroll back through this. What you will see develop, especially in a bull trend, is now negative two. If the market, anytime the market gets close to negative 2,000 intraday, you got to be looking for a low. You just have to be. Now, there will be that rare time where it will go lower and lower and lower. But again, that's where your strategy and your tactics have to be designed to keep you from, you're trading price. So price has to confirm the analysis. But if I see breadth, negative 2,000 intraday, I'm taking a real hard look at any short position I have on, and I'm taking a real hard look at pivots If a certain pivot is taken out to the upside, I no longer want to be short that type of thing. And what you'll also find is that these trends tend to have personalities. And intraday, you'll have this from day to day, and intraday, you'll have this expansion and contraction of breadth. And that's showing the incredible bid in the market. The institutions have been buying this market from here. They're only going to let it go so low before they jump in and buy it because they're afraid they're going to miss the opportunity. They are charged with buying millions and millions and millions of dollars of stocks, okay, long. They're either going to be long or they're going to be short for the most part. And they're not going to go in there all at once and do it. So what they're trying to do, they're trying to get an average price. So the market is only going to drift so low before the buying comes in to lift that price. And that's what's going on when these big institutions are in a buy mode. And that's what we're seeing. It's basically what we've been seeing since March of 2020. Now, back to what you will typically see intraday levels like this reached, and then the market will take off to the upside. You want to be paying attention if the market's negative 600, negative 1,000 intraday, then you want to start looking at your levels up here. If it's holding previous pivot lows, and that's something else, it's real simple. If the market's making, this is another way of viewing value, the migration of value. If the market's making higher highs and higher lows, it's going higher. It's done nothing to tell you that a high's in place. And you'll have these areas like this. This was an area over here that was tested to the tick here. I mean, it's uncanny how they hold. You will have the occasional false move like you had here. But look what happened here. This was the deepest contraction in breadth since the kickoff to this move. So you had to be paying attention in here. This was on the close, and we gapped up the next day and it was off to the races again. So now, if I'm looking at this just road price wise, today's low is important, which is where we started this webinar. This is today's day session low, and it's also the low of the Fed announcement. So, trading doesn't have to be complicated. You want to use simple things. You want to have a valid form of analysis. I don't think there's anything more valid than viewing the market through auction market principles. It's not always cut and dry. Nothing is, but it is the most consistent, objective way of viewing a market, and it is the most helpful in identifying market condition. And you have to be able to identify market condition to be consistently profitable. And then if you can consistently identify market condition, then you have a basis for developing a trade plan. You have a basis for developing a trade plan that has strategies and tactics that lead to a positive expectancy. And that's what trading is all about. And this is true in all time frames, whether you're a day trader, whether you're a swing trader, whether you're a long-term position trader. Okay, question or two here. I'm going to read a statement from Roger. Roger is a very advanced practitioner. Tom, if you're okay to venture outside of equities, there's possible complementary market activity in bonds today. There was a smaller balance area this week at the extreme of the mature balance area. Today's bond was a small FBO, false breakout, that extended through recent range in one day. Possible selling tail, closed at lower range. FBOs can often precede initiative moves. Absolutely. If there's continuation follow through, seems possible market statement in bonds similar to equities discussions. Absolutely. And what Roger is saying here is absolutely spot on, and it sort of mirrors what I tried to say earlier that I went over quickly. What I have done here with the analysis that I have shown you guys in equities today It doesn't, you can go to gold, you can go to crude, you can go to bonds, you can analyze stocks. It's based on how an auction market develops. All of those things are traded in an auction market media. So the same principles drive the development of those assets that drive the development of stock index futures or the stock indices or anything you want to trade. And another thing, I talk about this a lot. This methodology is ideally suited to trade anything and in any time frame. And I trade intraday, I trade leveraged ETFs, I trade options, I trade gold, crude, silver, bonds, across the gamut. And I think you're selling yourself short, pardon the pun, if the only thing you're doing is trying to day trade the S&P mini in and out all day long. That is the most difficult form of trading. It is the most random form of trading. It is the most abused, misunderstood, and it is the most highly promoted form of trading. The reason for that is because the trading industry is a transaction-oriented business. Without transactions and people doing stupid things, the business would cease to exist. The industry would cease to exist, at least as we know it. So that's my rant about trading. Now, you can trade very successfully intraday, but you need to be far more patient than is promoted, and you need to trade less often. Guys, anything else? Good stuff today. Thank you. Questions, comments, observations? Okay. You guys have a wonderful evening, and I'll speak with you again very soon. Somebody have a question? Mark, you raised your hand. What's the question? Okay. Okay, guys, have a great evening. I'll speak with you again soon.